We are going to zero in on a few key variables to make the case that, although technically solvent, Silicon Valley Bank was not practically solvent by any stretch. The short answer to why Silicon Valley Bank collapsed is what fancy people call a liquidity crisis. A critical mass of folks took their money out of the bank to the tune of $42 billion when the bank announced this past Wednesday that it was going to have to sell off like $2 billion in assets to shore up its balance sheet. It just so happens to be bonus season in much of the tech world, which is a big portion of Silicon Valley Bank's depositor base. So a ton of large companies in that sector knew they were going to have to withdraw even more than the normal amounts to cover payroll. To boot, many of these companies have seen their own valuations and incomes dwindle already. So the last thing they needed was not being able to send out paychecks to the folks who maybe they hadn't already laid off yet. If you were in this position of, say, a scrappy startup entrepreneur or a big biotech player, when your bank announces it needs to sell stuff to keep the light bill paid up, you too might get a little nervous about your money. So the short answer and definition of liquidity crisis in this case is the bank ran out of money. Now, however rock solid the FDIC's track record may be at keeping bank depositors whole, it is important to note that there is a limit on, I guess, what we'll call the ASAP version of the insurance, $250,000. Anybody qualified under this $250,000 will receive their funds as soon as possible, which is usually within a day or two, according to the FDIC website. If an individual or a business has more than this on deposit, those funds are parked in, I guess, what we'll call the wait and see version of the FDIC plan. Basically, for funds over $250,000, you get an IOU from the FDIC. As they sell off assets of the bank on Facebook Marketplace, you collect a dividend payment until you are hopefully made whole again. But how long does this take? According to the FDIC, the average payoff period is 6 to 12 months. But they go on to say, if the affair gets bogged down in the courts, or if the asset sales take longer than expected, maybe because everybody on Facebook Marketplace is bogging down your messages with things like, is this bank branch still for sale? You may have to wait longer than that. This is a problem for big depositors because they've got payroll coming on Friday and it's going to keep on coming. I've seen a lot of reporting seemingly ignorant of this fact, implying the tech companies are somehow to blame for doing what was in their best interest. Right or wrong, if you've got worries about your bank becoming insolvent, would you be loyal to your bank and hold out hope for your bank, or would you protect yourself? I've seen a lot of commentators and economists point out the fact that the bank was still solvent, as if maybe everybody, including the government, jumped the gun on this. Words matter, but they matter especially in the context of financial disclosures and accounting. This is Silicon Valley Bank's balance sheet as of December 31st, 2022. This wasn't published until February 24 of this year. We are going to zero in on a few key variables to make the case that, although technically solvent, Silicon Valley Bank was not practically solvent by any stretch. If we scroll down to the bottom, we see Silicon Valley Bank's equity at $16.2 billion. You basically have to add 6 zeros to the number shown here, as these figures are expressed in millions. This is what proves Silicon Valley Bank was solvent, as the calculation for determining equity is simply total assets minus total liabilities. Yay for solvency. Now, we want to scroll up and take a look at the asset side of that equity calculation. Not all assets are created equal, and they certainly aren't reported equally. Although they show $211 billion in total assets, let's dig deeper into a couple categories here. Cash is very straightforward. This is actually what means cash. Now, we're going to do available for sale securities. These are investments earmarked for sale. Most of these are bonds, including U.S. Treasuries and mortgage-backed securities. And the bank is stating outright that they don't plan to hold these assets, these bonds, until the end of maturity. Here's the big one: held to maturity securities. These are, again, mostly U.S. Treasury bonds and mortgage-backed securities. Held to maturity means that the bank is pledging not to sell anything in this asset class before the bonds mature. Now, I need you to excuse the editorial here, but it's the same folks at the Federal Reserve who told us inflation was just transitory. These are the same folks at the Federal Reserve that incentivize banks to load up depositor dollars into these assets as a safe haven. How safe are these assets when rates rise? not super safe, especially when your liabilities are blooming. There are two big problems with this category as it relates to the solvency of Silicon Valley Bank. Number one, if the bank suddenly needed to offload these assets to shore up the balance sheet in terms of liquid cash, because they are marked held to maturity, they can only do so if the bank's board of directors shifts the classification to available for sale. I'll admit I am murky on some of the details of how this process works in practice, but I believe it can only be done once a year, and it certainly is not something that can be done in a big hurry. 2, notice the available for sale securities include a reference right off the bat to fair market value, where the held to maturity securities designates the amount as based on the amortized cost. It turns out this is a distinction with a big, impactful difference. The simplest explanation I can give is that the number they show for the value does not account for the current market value. The 91 billion value shown in the main column is based on what they paid for the bonds. You have to go inside the parenthetical statement, which shows fair market value of 76 billion as of the end of last year. This is a difference in terms of actual value of $15 billion. The reason these bonds dropped in value is precisely due to interest rate hikes from the Federal Reserve. In a rising rate environment, bonds simply fetch a lower price. When the Fed was busy propping up bond prices, which kept mortgage rates low for as long as it did, these bonds are worth a heck of a lot more than they are right now. And this is the crux of the issue in my book. If you look at the reported equity of $16 billion and account for the current value of this asset class alone, you're down to equity of $1 billion. Now, take a look at the liabilities, specifically the non-interest bearing demand deposits. This is what normal people call checking accounts. You give your money to the bank in exchange for an IOU that you can redeem at any time in any amount that you have in the kitty. Silicon Valley Bank had $80 billion in these IOUs. It turns out when your cash balance is only $16 billion, and much of your remaining assets are not immediately accessible, and you've effectively overstated the practical value of the largest single segment of your assets, you are practically insolvent, and the FDIC is going to shut you down when depositors demand their IOUs on $42 billion. Well, I hope you found this explanation interesting. But more importantly, I hope you subscribe so you don't miss my future installments in this series. We're going to touch on matters much more practical to what I do for a living and relevant to you, especially if you see yourself getting a mortgage anytime soon. At First Bank, I can handle your mortgage in almost all of these great United States of America, with the exception of Maryland. Sorry, Maryland. I hope to talk with you again soon, and I'd love to earn your mortgage business. Call or text me anytime at the number below. Thanks for watching.